Hello everyone, my name is Trenton Crouch. Thanks for taking the time to watch my presentation. The topic I will be covering is premium and luxury brands, and the article we will analyze was found on Forbes. It is called Providing the Value of Luxury Brands, and it is written by Stephen Diorio and the Thought Leaders. So first, let's jump into the topic overview. And let's try to answer the following questions. What are luxury products? How are brands and the branding process significant to the luxury industry? And finally, how do shifts in consumer buying preferences impact the business? The luxury industry specializes in building brands for unique, high-quality products and selling them for higher prices than other products in the same category. For the luxury industry, the brand and its image is the primary generator of sales margin. As such, it is critical that these brands are managed as financial assets. The luxury industry must carefully balance its focus on accomplishing short-term marketing objectives for short-term profits with maintaining and building brands that will contribute to the creation of long-term value for the firm. Consumer preferences are shifting away from how these luxury brands were traditionally brought to market, and are further increasing the importance of how organizations manage these short-term and long-term trade-offs. We will look at this closer as we continue. And now, let's look at a few firms that Diorio highlighted in his article that mismanaged those trade-offs and suffered major consequences. Pierre Cardin devalued their brand via over-dilution when they indiscriminately licensed the brand to 900 companies for short-term revenue and profit growth. Kraft's brand suffered large losses when its private equity investors made budget cuts to the strategic brand investments in hope to spur quick revenue increases. And finally, P&G had to write down the value of the Gillette brand because of competitive digital disruptors like Harry's and the Dollar Shave Club. So what does Diorio say about managing brands? In his article, Proving the Value of Luxury Brands, Diorio uses luxury products to highlight the importance of managing brands. He explains that when companies manage brands as financial assets and quantify their value, marketing can then collaborate with finance and investors to allocate resources strategically as well as measure and track brand strength. Diorio writes that luxury brands have traditionally been linked to scarcity, heritage, sensory-rich retail experiences, glossy print media, and catalogs. But now, consumer preferences are shifting to new markets and innovation and buying through digital channels and mobile channels and social channels. Since luxury brands contribute to majority of a luxury firm's value, it has become critical for the luxury industry to focus on managing its short-term profit growth with growing long-term brand growth and firm value. Marketers need to cater to a new generation of consumers, but also need to realize the dangers that come with commoditization, price transparency, broad availability, and the comparability that these digital channels can have on a premium brand. Now, to bring it back to the text and wrap it all up, it is explicitly written in our book that luxury brands are perhaps one of the purest examples of the role of branding because the brand and its image are often key competitive advantages that create enormous value and wealth. This is very relevant to what Diorio explains in his article about how brands should be valued and monitored. For luxury and premium products, the brand is what's allowing for the product to sell at higher prices than other competitive products in the same category. Secondly, in our text, we read about how consumers have viewed luxury products in the past as items of status. We read about how they are viewed now as items that provide style and self-expression. And we read that a winning formula for many organizations in the luxury industry is craftsmanship, heritage, authenticity, and history, which is sometimes critical to justifying the extravagant prices that people pay for the luxury items. As previously mentioned, Diorio listed a similar set of formulas that make luxury brands successful: scarcity, heritage, retail experiences, print media and catalogs, etc. Diorio elaborates on this point to reach a third concept from the text: That is the shifting of consumer preferences. In the text, it is written, globalization, new technologies, financial crisis, shifting consumer cultures, and other forces require them to be skillful and adept at their brand stewardship to succeed. Diorio touches on these concepts and elaborates on how shifts in consumer preferences can lead to faulty marketing strategies that can result in negative effects on the brand, such as the previously mentioned commoditization effect or the increased ability to compare competitive products. As far as discussion questions go, one thing is for certain, and that's that I have more questions about branding than I had when I started the assignment. First, how do companies determine how much focus they should be putting on short-term profit growth and how much focus they should be putting into developing their brand? How do they agree on the financial value of the brand, and how do they measure its strength over time? What are the actual mechanics? Another point that raised questions for me is why don't all organizations measure, report, and manage their brands as financial assets? And the article explains that many organizations view marketing expenditures as expenses rather than investments, and that this makes it difficult to understand what marketing is actually contributing to the business. The article explains the consequences Pierre Cardin, Kraft, and P&G suffered for making this mistake. But the real question is, why are companies making it? I think the misalignment and miscommunication between competing pressures in a business, such as the marketing department, the finance department and their agenda, the investors and their agenda, can all contribute to how the brand is measured and managed. Each division needs to have balance in how they view the brand and the strategy. Until they can agree on a common economic value and purpose for the brand and measure how marketing is contributing to the business quantitatively, then they will also continue to struggle to construct a solid growth strategy that allocates resources appropriately to drive continuous, sustainable brand growth. Overall, I have a brand new perspective on the significance of brands after completing this assignment, and I can easily see the challenge and importance for luxury products to have a well-managed brand. Organizations have to be very strategic on how they want to allocate their resources because at the end of the day, their brand is what will grow and maintain the firm's value in the long run. So again, thanks for listening to my presentation, everybody. I really appreciate your time. And we'll talk later.